China's under-pressure economy is displaying more signs of stress on multiple fronts. The latest figures show retail sales, industrial output, and investment all growing at a slower than expected pace. Underpinning the broader economic slowdown is a liquidity crisis in the property sector, which is directly and indirectly causing sustained weakness in consumption. Alarm bells also ringing about the country's so-called shadow banking sector, which has heavy exposure to the property industry. Firms affiliated with one of China's largest private wealth managers have missed their payments. All this prompting China's central bank to unexpectedly cut key interest rates in the hope of encouraging banks to lend more money to businesses and consumers. It lowered the rate on its medium-term lending facility by 15 basis points to 2.5%. The 7-day reverse repurchase rate was also cut by 10 basis points. And for more insight on this, we speak with Steve Cochran. He's Chief APAC Economist at Moody's Analytics. Welcome, Mr. Cochran. Now, we just spoke about what the PBOC did. Now, 15 basis point cut in the Chinese context, and that is large. I think usually it's between 5 to 7 basis points. But given the picture, what we are seeing right now, the new bank lending at its lowest since the great financial crisis, the global financial crisis, pardon me. But what the central bank is doing in China, does that come anywhere close to addressing all this range of problems we have already mentioned?
Well, this is something that we have expected. We thought that there would be a number of cuts on different rates across the financial system. And so this is beginning. As you mentioned, 15 basis points in the context of Chinese policy is a lot. And so it may have a bit of an impact in terms of sounding like, okay, loans are going to be a bit cheaper. Maybe now's the time to get in and borrow. The problem is that simply consumer confidence and business confidence is very, very low right now. There's not a lot of appetite for taking on new debt, partly because business conditions are weak, partly because many households and businesses already have high debt loads. And in a sense, they'd rather save and try to reduce their debt loads rather than taking on more debt at this time. So this is one piece of the policy picture, if you will, but it's only one piece. And I think it will take a lot more than just this to get the economy kickstarted one more time.
Well, if underlying demand and confidence deficits in both, and both feeding each other at the same time, it's not the fact that borrowing is costly. And therefore, if you cut these rates, it then becomes cheaper to lend. And therefore, people will lend and then they will spend and they will invest. In a way, cutting these rates, they will really do nothing at all. What other pieces of the policy puzzle need to be there to fix this problem with sentiment and confidence?
Well, I think it will take multiple policy moves, and that's because there are many, many imbalances in the economy right now. And so many of them have to be addressed really at the same time to put a floor under the economy and to get that virtuous cycle of investing and spending and so forth back going. So lowering interest rates is one, and that, we could broadly call that monetary policy. The next one would be fiscal policy in terms of encouraging spending, either direct spending by government or finding ways for private companies or for households to spend. It could be by providing vouchers or cash incentives or something for households or companies to spend. So, and that's particularly important, again, because the consumer confidence and consumer spending in China is so weak. And then there can be specific incentives given towards individual industries in terms of easing up regulatory barriers to doing business, or easing up the ability of the a private banking system, the private financial system to invest with greater efficiency in the economy. So there are many, many ways that can be taken. Part of the problem is that sort of the old tried and true methods of stimulus probably aren't so appropriate right now. So back over the last 10, 15 years, when the economy has gone through a slow patch, there's been quickly a turnaround in additional spending on infrastructure, or selling more land to property developers and having more housing built. But China doesn't need much more housing right now. China has plenty of infrastructure. So these kinds of tried and true practices that the Chinese government has done very, very well in the past simply wouldn't be quite as effective as they used to be.
And the final question, you may not have an answer for this. This is a headline for us today, that the fact that youth unemployment rate figures were not released. Now, that is not the thing to do if you want to boost business and consumer confidence, is it, at this time?
Well, it certainly raises a lot of questions as to why the number wasn't reported. It is when economic times are tough that you need more information rather than less information. So taking some of it off the table doesn't help very much. I think one can say that the youth unemployment rate, there's always been a few problems with that data series, but no data series is perfect. This one, like many coming out of China, is not a seasonally adjusted series, so you get some volatility, particularly in the summer months when graduates are leaving university and getting out on the job market. You always get a bump up at the unemployment rate that can be misinterpreted. But one of the better things about the youth unemployment rate is it does seem to move and react more to economic conditions than the total unemployment rate for the entire workforce. It's a fairly static number. It moves to a very small degree from month to month. So we miss that indicator of the youth jobless rate that tends to react a little more, show a little more indication of what's going on in the labor market. So it's a little puzzling. I guess the final point I would make is that all around the world, statistical agencies are constantly working on improving the data series that they produce. But when they do that, they're not taking the one data series off the table for a while. They'll work on it. They'll ultimately submit a revised series, perhaps revise the historical data back. But it's all done rather fluidly, if you will. It's not that they would take a data series away, come back a year later with a better series.
Oh, thanks so much for joining us this evening, Mr. Steve Cochran, Chief APAC Economist at Moody's Analytics.